It is 10 minutes past 9 on Thursday, the 14th of May. Another bright sunny day here in London. And on today's market broadcast, I have got the founder of our business at Southbank Research, is Dan Denning, who used to be the publisher here before he went on to do greater things, who is based down in Australia now. Dan, how are you doing today?
Yeah, I'm really good, boss. Thank you. How are you?
Yeah, I'm doing pretty well, all things considered. The length of my hair continues to get to levels I didn't think possible, but everything's quite manageable, all things considered. Before we get into sort of some market-based news, so you mentioned, Bert, just before we started recording, that you had a tale to tell us about getting physical gold. Now, this has been a story we've been looking at for quite some time, with just all of the supply chain disruptions that the Wu flu has done to the gold market in general, all the way through from miners to refiners to sort of retail distribution. Every element of the gold supply chain has gotten messed up. And you have a story to tell regarding the scarcity of physical gold these days. Tell us what's going on.
Yeah, so I'm actually getting ready to leave Australia on Sunday. I leave Melbourne on Sunday for Sydney, and then from Sydney I go to San Francisco. So we can talk about that later as well. But when all this kicked off, kind of in mid-March, being paranoid like I am, I sort of stockpiled some cash from the ATMs in case I might need it later, and in case the ATMs weren't working, which is actually something I've recommended people do for a long time. But I want to get rid of it now because I'm leaving, and to be honest, I'm not quite sure when I'll be allowed to come back, because international travel may be dicey for quite some time. So I thought, well, I'll see if any of the bullion dealers are open and if they have inventory, because about a month ago we were told by a lot of people that you couldn't find physical gold in the stores, maybe coins if you were lucky, but at a really big premium to the gold price. Yep. So I got up around 8:30. I go down Collins Street, which is where I'm staying, just go down about 3 or 4 blocks, walk in. There's one other guy at the counter. There's nobody else in line. I ask if they have what I'm looking for, and I didn't buy a huge amount. Here in Australia, you can buy, without any photo ID or proof of residence, you can buy up to $5,000 worth of gold per day.
Right.
If it's more than that, you have to show ID and all that. But I said, well, look, here's what I'm looking for. Do you have that? And she said, yeah, no problem. Are you paying cash? And I said, yeah, I'm paying cash. So she goes back to acquire my gold. And the guy standing next to me, properly socially distanced, he's buying silver. And I said, I thought it would be busier. I thought there would be a longer queue. And he said, no, wait 6 months, mate. Then there'll be a queue. And it's all your country's fault. It's your Federal Reserve. It's a giant Ponzi scheme. A Ponzi scheme. And I said, yeah, you don't have to tell me twice. But I was actually really surprised, not only that there was nobody there, but that they had what I was looking for. And as I said, it wasn't a huge order, so maybe that would have been more difficult, but it wasn't difficult at all today.
So when you say like not difficult, well, in terms of the inventory that they did have, was it quite clear that they had plenty?
Well, I didn't ask for what they had. I asked for the weight that I wanted to walk out with.
Right.
And I didn't care in what form it was. I didn't care if it was coins or cast bars or whatever. So I suppose maybe I'll ask that tomorrow, because I'm going to go back and see what's available in terms of their inventory. But for at least for today, I was there right when it opened. There was one other person there, and she said that it was a lot less busy now than it had been in March. I asked her, I said, is it busy? She goes, not nearly as busy it wasn't. Now, they may be doing a lot of business online as well.
Yep.
But yeah, I didn't know what to make of that. I mean, one, I was relieved personally because it solved the problem. And two, it tells me that people's initial wave of panic has gone away a little bit, and that usually means it's a good time to stack, as that guy said, or if you get a good price to get in. But the gold price itself hasn't really come down much.
No. It is interesting, that dynamic with people buying loads in March. Over here in the UK, like I've not been to any physical bullion stores, But all of the sort of trusted dealers I'd go to online. It's interesting just the degree of sort of scarcity for the kind of the kind of coins that in general that are considered the standard has this lack of them. So you often see now, because there's such a scarcity from some bullion dealers, that the main what they're trying to sell are these really novelty coins that nobody had bought previously, but because they're the only coins that they have that contain silver or gold, they're being able to sell them and at a pretty high premium as well. So silver coins have Star Wars characters or Marvel superheroes. Like, these are really novelty things, but because they're run out of the standard Britannias or Maples or American Eagles, they're able to sell these strange sort of niche coins because people want silver and they don't really care what kind of silver it is. I've not seen like the sort of that much of a relaxing of the shortages this way, but of course then we're there aren't many active gold mines in the UK, and while in Australia, of course, that's kind of a different story.
Yeah, who knows? It's just one data point and one day, so I don't know what the state of the market is. I will say that the other thing I had considered doing and tried to do, but elected not to do, was I went to the Rolex store on Collins Street to see if they had just your basic black Submariner, which is kind of it's not the entry level model, but the Submariner, I'm told, is, from my research as well, is probably the most collectible Rolex. And it's kind of like a TIP bond, a Treasury inflation indexed bond, that it keeps up with inflation over time. So if you're looking to get rid of cash for a different kind of metal, luxury watches are an interesting market. But there's two factors that affect them. Well, there's three. One, you can't get them in the store because the supply is very limited each year. So the guy at the Rolex store said, I don't have anything for 10 months. I can put you on a wait list. But there's a gray market for it. So they're not authorized resellers, but there are reputable resellers of secondhand watches, and obviously in various conditions, box and papers that show that it's not a forgery or counterfeit. That market's quite hot right now. And actually in that market, prices are going down for the entry level models, but up for the top tier models. So Rolex did a celebration anniversary watch called the Hulk, which is a green dial face and a green bezel, the part on the outside. That watch in Australian dollars sells for between $19,000 and $23,000, but you can find it in various spots for at the lower end of that range. So part of my theory is that that's an asset that people liquidate when they can't or don't want to sell anything else, because you can easily sell it in the secondhand market. But I couldn't find one. Australia is a smaller market for that sort of thing. And I went into a store that had two. There was not that big a difference in price, but they were damaged because they were gently owned. So I thought, you know what, I'd rather just walk out of the country with some gold instead of a watch.
Yeah, so that seems like a fair enough decision to make. It is always interesting the sort of the culture around luxury watches. I understand that but from my small experience with Rolex, with saying we'll put you on a wait list and we can get you on in 10 months. I think there's some kind of thing where if they don't know you, if you've not been there before, I've heard that there's a sort of a thing where telling someone that they'll put you on the wait list is generally their way of saying, we have them in store, but we're not going to sell to you because we only sell to your friends with pretty much. But that is just
well, that's good to know. I mean, he did say that they don't like selling to people who walk in off the street because they're worried that they'll try to flip the watch.
Yeah. So they're so this whole thing of trust where they'll notify people who previously bought Rolexes ahead of time if they're releasing a new one. So they sort of favor collectors rather than people, because like you say, people will flip them. Here in the UK, if you want to get a Rolex, black Submariner, as you describe, I think in general, as you say, if you go to Rolex, if they don't know you, they'll say, we'll put you on the waiting list, but it'll be a year or something. However, you can buy one well above retail price, as you describe in the gray market for them. It is. There's that whole sort of culture thing, and I always do wonder whether or not the supply, how much Rolex deliberately restricts supply of these things, just in order to keep the price going. Because as I understand, the movement within the watches themselves, they haven't really improved very much for several decades. They're not going to great lengths to improve how much time the how much time the movement can sustain itself. They're not trying too much. They're just sort of releasing slightly different watches every now and then, which have a big novel feeling with it. Are there any? You say you go for the Rolex Submariner, sort of the standard, the luxury watch, and the most collectible one. Are there any? Have you ever looked more deeply into the watch market for watches that trade like financial assets, like the Treasury inflation protected security?
No, this is a first for me, and I mean, quite honestly, there's not an elephant in the room, but the reason I'm interested in this and not Apple is not because I don't like Apple watches. It's because I don't want to buy tech stocks. I don't want to buy the Nasdaq at this level. I don't want to buy any stocks at this level. So I would rather put the cash in. I would rather have less cash and put some of that cash in something that I can physically own and possess, which is, it's a very defensive position. But the watch investigations are new to me, and what I started out with, just to see if I would have any buyer's remorse, is I bought a Tudor watch, and Tudor is kind of like an off-brand Rolex. It's made by the same company. They just do the marketing slightly differently. So, I think, as you said, Rolex, a lot of the value in the watch is the prestige. It's a diving watch, the Submariner, and most people don't dive, right? So they buy it because it's a highly accurate precision timepiece, and as you said, the supply is limited, so that supports the price over time, and it's really, really well made. It's hard to counterfeit. The Tudor, I thought, because it was my the first luxury watch that I was interested in, I wanted to see if I would get buyer's remorse the minute I bought the thing and brought it home. I haven't even put it on, and honestly, it's not something I intend to wear. It's just a way of putting some cash in a different type of asset. And I just like the way they look. For me, it's a little bit, it's like art or wine or even whiskey or the other collectible markets. There's two factors. One is there liquidity for it? Is it something you're going to be able to sell again if you need to? And it's not hard to find out a lot about a new market if you don't know anything about it. And then you have to like it. It's really largely a matter of taste. Is it something you enjoy, something that you want to own, or is it just purely a financial asset for you? And for me, it's a little bit of both. But I can see why people get really interested in it. And like anything, it doesn't. You could spend about a day, I think, and learn the basics so that you didn't make a really stupid decision. And for me, having studied the stock market and been in financial publishing for all these years, you had this week, you had David Tepper, you had Paul Tudor Jones last week, you had all these billionaires are suddenly telling us that the stock market is expensive, which means they must already have their sell orders in, or they must have already taken profits.
Right, they've already bought the Rolexes.
Yeah.
Before we get before we delve too deeply into sort of the alternative asset space, I'd like to let's go a bit further into that with the billionaires saying stocks are too expensive right now. With yesterday, actually, of course, we had Jerome Powell saying negative interest rates aren't on the radar. Quite a firm rebuttal to the idea. What do you make of that? I mean, because in a way, when you see how negative interest rates have been implemented in the Eurozone and how it's really gutted the banking system there, it seems you could almost argue that it's bullish that they're refusing to do negative interest rates. But at the same time, the fact that the market is in the Fed funds futures market, they're betting that negative interest rates are coming. What does this really say? I mean, is this a good thing? Is this a bad thing? I mean, I think it's a great thing for the American saver in general that they're not going to be put through this brutal regime of negative interest rates as they have in Europe. But what do you think it means for the sort of broader economy in the US?
That's a great question because it's the first time that Powell seems to have shown any interest at all in reasserting the theoretical independence of the Fed from the political pressure, because of course the president keeps tweeting about how great it would be to borrow at negative rates, and that the U.S. should have negative rates like Europe. And there's no empirical evidence that that stimulates consumption or growth, but we keep hearing this argument from people like Ken Rogoff. So I think Powell saying no is him saying, look, the Fed did its job in terms of providing adequate liquidity in the credit markets on Wall Street, and it's limited in what it can do to try and stimulate the real economy. That's the job of fiscal policy, which is what he suggested. He said that we probably should do something because if Congress doesn't do something, then recessions take much longer to recover from, especially the employment side. You know, if there's 30 million unemployed Americans in the last 6 weeks and the unemployment rate is 14% now and it's about to go to 20, they're hoping that, I think Powell's saying, look, that's not our job. We did our job. We supported asset prices. And in fact, if you also look at the 10-year yield in the US, you can see that really since about April, the Fed seems to have adopted a kind of soft cap, which they had called previously curve control. So they're trying to control borrowing costs, not only for corporate borrowers, but for the U.S. government. You know, yesterday the U.S. government announced that in the first 7 months of the fiscal year, it ran almost $1 trillion deficit. And actually, it's probably more than $1 trillion. I don't have the numbers. I think it's 1.4 trillion. They did 3.3 trillion in spending, and of course the tax receipts fell off the shelf. So the Fed's trying to control borrowing costs for the government. So that Powell's stocks don't like that because, you know, since the Fed got involved in late March, the market went up 30%. So he's right, though, that the Fed policy and interest rates can't really do anything for a problem that's now driving earnings, which is soaring unemployment, shuttered businesses, and massive deficits.
It does seem like there is only so far that you can go with the interest rate cutting regime to actually aid the situation. You know, liquidity is one thing, but solvency is another. So we've seen all of this liquidity being added to the market, and to ensure that there is, there's buying and selling of various securities all the way through the risk curve, from the supposedly safe treasury bond all the way through now to junk. But that can only help so far if provided everyone stays solvent, right? I mean, if there's an actual buying and selling a security is fine, but unless you need to be able to roll over the debt, you need to be able to issue new debt to pay off the old debt if you're really in trouble here. What do you think we're gonna see? We're gonna reach the end of the line for some of this stuff. There are going to be actions where we're going to see major bankruptcies, where all this Fed stimulus is revealed not to avoid.
Well, I think that's the billion-dollar question, because the bullish argument, or the argument that's come from macroeconomic bulls and stock market bulls, is that the spike in unemployment, the cut to GDP, and the cut to first and second quarter earnings isn't a function of what was going on in the economy. It's purely because of the policy response. So everything before, and Powell said this, which is shocking and not true, is that that all of this is virus related. That there was nothing wrong with the economy before the virus hit, and that's wrong. There was tons of debt, tons of speculation. Interest rates had remained low, but I think if the bullish argument is correct, then you'd see the V-shaped recovery that everyone talks about. That employment would recover quickly. People would go right back out and start spending the way they spent before. Now, I don't know about you, but the more you talk that through, you realize that is not going to happen. One, a lot of businesses aren't going to survive being shut down for as long as they've been shut down. So the only solution now, which is why the Congress and in the UK the government will have to get involved, is the government is going to have to directly subsidize not just wages for people who are furloughed, but operating expenses for businesses who can't operate. And there are tons of businesses that would probably have gone out of business anyway. Just the natural attrition rate in a free market, in a real economy. But I don't, that's not affordable either. You can't take on everybody's payroll and then all the businesses' operating expenses. They just, that's the limit of the policy response. And I think that's why you're seeing stocks start to teeter, because they went down by, the S&P went down by what, 35% in a couple of weeks or in a month, and then it went up by 35%. And now people are like, well, what does the second half of the year look like? Well, if small businesses can't open, if people can't travel, if supply chains are still uncertain, and if consumers are badly scarred, not just on the actual balance sheet, but in their head, the economy's not going to look anything like it did in January and February. And I don't think, the Fed can't do anything about that. Congress or governments can run these big deficits, but the best analogy I can use, Boaz, is did you ever build model airplanes as a kid?
There was an attempt.
Yeah, they're hard to do, right? It really
Yep.
challenges your attention span as a teenage boy, because you've got dozens of parts, sometimes hundreds of parts. They're small. You have to use glue. You have to not use too much glue. You can't get your fingers stuck to the parts, and you got to wait for it to set before you can keep moving. So in economic terms, it's an exercise in your willingness to delay consumption. Your satisfaction doesn't come until much later, when the thing's hanging from the ceiling or it's on the wall and it looks great.
Right.
What the policy response to the virus was taking like a Lancaster bomber that's 3 feet long and 6 feet wide or whatever, and smashing it into innumerable pieces, because you said that was the only way to protect it from the flak or from the Germans. And then now telling people, just put that right back together. Just go ahead and do what you were doing before. They assume that all the billions of decisions made by people on a daily basis that support their incomes and support the mortgages they borrow and the schools they send their children to and the job they quit or the job they take or what businesses do, they assume that all of that's just going to happen because they say it's time for it to happen. You can't put something like that back together. And that's the fallacy in thinking that the economy is a machine with an off switch. What they're going to realize is they're going to flip the on switch, but there's no on switch in people's brain. People have a very individual assessment of what's best for them economically. And I think the stock market is finally saying, okay, the liquidity was great, but now what's going to drive the real economy if we've smashed the Lancaster bomber?
Yeah, and don't even get started on the paintwork, I guess. I mean, it's such a the stock market. It's almost like sort of the vanity part of the economy. I mean, it's the very, very peak of the capital that's invested in it. It's this it is the equity between the assets and the liabilities after all. So I mean that's the sort of the finest part of it. That's the most delicate part of it, and that's why it can trade up and down like this. The fixed capital investment, in the real economy, as we would describe it, is what's been really very, very badly damaged by the whole the entire Wu flu lockdown and the Wu flu in general. I saw the Bank of England, their latest report has given an estimate for the second quarter of this year that of negative. Well, I mean, so it's a bit of an oxymoron, but negative growth of minus 30%, which is, and following their historical record in real GDP terms, this would be the worst year for the UK economy since 1709, when there was a great freeze, the Great Frost. It was caused by a solar minimum, I believe, which led to temperatures in London of minus 12 degrees. It seemed like an interesting comparison with the sort of freezing of the real economy, and where it was back to a time when the economy really was just frozen. Going forward from this, I mean, what do you think are the indicators that people should be looking for? I mean, do you think inflation in this environment is going to go sideways, or do you think it's going to go up with all the stimulus?
Yeah, that's another huge question. I mean, I think a minor indicator to look for is look at the labor participation rate if and when things open up. Is how quickly do the jobs that were furloughed or let go get refilled, and how quickly do people get back to work? So the percentage of people who are willing and able to work being employed in the economy is, like, for example, here in Australia, those numbers just came out at 63%, and that was down 3%, which is a major decline in terms of the structure of the labor market. So that'll give a big clue. But in monetary terms, I think we discussed this last time I was on. All of what's going on right now argues for deflation in terms of consumers either spending government checks to pay down debt or saving that money and then not being able to travel, to take a holiday, not wanting to go outside to shop, to eat, to go to the movies, to go bowling, if people still do that. These kind of discretionary consumer behaviors will dry up. So that argues for falling prices for stuff. But you have this huge increase in mostly public debt and in the money supply. And the only thing that's preventing that increase in the money supply from triggering greater inflation in consumer prices is it's not made it through. That extra liquidity has found its way into asset prices. It's not been passed through by banks to businesses and consumers because they're in a different phase right now. So I think we discussed it once before, but I think in the long term, what you'll see is the discussion and then probably the introduction of individual bank accounts at the Bank of England or at the Fed for ordinary people who are perhaps people who are currently unbanked, and it will be digital money. And that way you don't need a helicopter. You can just deposit the money directly in the person's government bank account. And as I've said in the past, you can make that money expire by the end of the month so that it has to be spent. So it's more like an allowance that doesn't roll over, or you can even impose a negative interest rate on it. So it doesn't require a high net worth depositor at a bank. It says, if you open a government banking account, we will debit it each month with £1,000, but you've got to spend all that money. And the longer you wait to spend it, the less there will be to spend. I know that people think that that's not possible, but to me, that's the logical destination. And that was what was discussed in the last Great Depression in the 1930s. That's what the Chicago plan was. I've written about this for a long time, but it was removing banks, commercial banks, as the mechanism for releasing growth in the money supply into the real economy. So until that happens, I think you see deflation. But at some point, it will happen, and then you'll see inflation.
Very interesting sort of themes all coming together there. The idea of having a bank account directly with the state seems to be something that gets bandied around more and more these days, especially when folks talking about digital currencies, digital sterling, digital yen, digital yuan. All of this generally ties back to an idea that it's a currency that's not run by the banks as much as it is run and deposited with the government. And it all seemed interesting when you had the likes of you just get central bankers like Mark Carney, for example, talking about the digitization of currencies and where that might go. I mean, here in the UK, it's possible to already get a bank account of sorts with the government, with NS&I, National Savings and Investments. That's with the Treasury rather than the central bank. But it's still the same idea that you've deposited your money with the Treasury, and of course you're effectively just lending it to the Treasury, and you're trusting that if you call for the money back, they'll give it you back. But in essence, it is already a bank account. So the idea that would be expanded a lot more, it doesn't beg a belief from my side. But it just seems interesting. When will there be this sort of big push to try and get it moving forward? You did mention earlier that you'll be heading off to the States sometime soon. Could you? I know you generally keep such plans very close to the chest, and you won't be able to reveal much. But can you tell us what your goal is? Because you previously had this great exploration of the U.S., finding bolt holes to find refuge in during a social and economic crisis. Will you be doing more of that when you're in the States?
I guess I'm going to play it by ear. I mean, part of what drove the decision is I'm an Australian citizen, but I don't usually reside here. So I've been here for 5 months out of the last 5 years. So that's why I'm allowed to leave, because if I were considered a citizen, a usual resident, then I would be covered by the government's ban on international travel. So I thought, well, I better leave. I have this window to go, and I'm not really prepared to stay for years, so I should go. And most of my family is back in the U.S. But I do think, yeah, to answer your question, I think I don't. One thing I've avoided in this entire pandemic is trying to become an epidemiologist and study models and pretend to be a statistician and know things that I don't know. But I do get the sense that as things open up, as they will have to let the economy do whatever it's going to do, then you're going to inevitably see a second or a third wave of infections, and the response by governments will be more of what we've just seen in the last 6 weeks, which is a more permission-based society, whether that's with respect to your physical movements, your financial movements, or whether you can even see your mother on Mother's Day. You know, these ridiculous prohibitions against completely private personal behavior. And so my sense is between now and these rolling waves of oppression, it's probably better for me to be less of a vagabond and more stationary, and then pick a spot that suits me, addressing those things. Where can I be closer to family? Where are my financial affairs going to be in good order? Where is it easy for me to travel internationally if that becomes more frequent and possible in the next 6 months or next year? So that'll drive the decision. And it also, I think, I'm interested to see what happens in different real estate markets if 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 there is a big recession and if there's another big down leg in the stock market, which I expect. I think that means there'll be a lot of sellers of physical assets, and I want to be closer to where those are so I can buy some of them if I like them.
It's a fascinating strategy, Dan. I must say, I'll be very interested to hear how this plan goes. Perhaps you'll be able to come on these market broadcasts in future when you're based in the US. But that's all the time for what we have for today. Dan, thank you so much for joining me.
You're welcome. Thanks, Boaz.
That was another market broadcast with Dan Denning, who now writes the Bonner Denning letter over in the US. And that is all for today. We shall be back tomorrow. I have got Tim Price on the line, who will be giving much of his musings tomorrow morning. But that is all for today. As I say, it is now 9:43. Hopefully you'll get this relatively soon. And we shall be back again tomorrow. I hope you're keeping safe and in good spirits. And we shall be back with you shortly.